Okay, let's talk about a horrible subject called bankruptcy. Now, I said this before, you can't go bankrupt if you don't have any debt. So bankruptcy is a debt proceeding. So if you have an all-equity firm, if you put money into your own business and your business closes and you shut down, there's no bankruptcy procedure because you have no debt. You have no creditors that you have to pay that you can't pay. Everyone's been paid, there's no bankruptcy. Bankruptcy is over. So when we think about bankruptcy, it's a trade-off between the tax advantage of debt and the costs of financial distress. And it's difficult to express with a precise and rigorous formula. So how much leverage you want to have is going to be a variable that each firm is going to make up on their own. And remember that as long as you can pay your bondholders back, you can close operations and go out of business. But going out of business and going bankrupt are two different things. Going bankrupt means that you can't pay some debts. If you can pay all your debts, you didn't go bankrupt. You just closed the business. And that's a different way to end operations. The bankruptcy process, the business is a failure. It's terminated and with a loss to creditors. With a loss to creditors is the key. A legal bankruptcy, you petition federal court. You have a technical insolvency, is you're unable to meet your obligations, but you are basically cash poor. You have assets, but you'd have to sell them to pay your obligations. So if you're cash short, you're technically insolvent, but you definitely aren't, or you might not be. And of course, accounting insolvency is the book value of equity is negative. Well, the book value and the market value obviously can be dramatically different. The book value of a depreciated house could be zero, but clearly the house is worth way more than zero. So the accounting bankruptcy is a whole different thing. But there's three different ways to look at bankruptcy. Also, the proceedings. The Chapter 7 is a complete liquidation, which is the trustee takes over the assets, sells them, distributes the proceeds, you're done, you're shuttering the doors, you're closed up shop, you're done. Chapter 11, however, is a restructure of the corporation to pay, with a provision to repay creditors. So Chapter 11 is more common. In other words, I've gotten over my head, I have a business, it has cash flow coming in, etc. I just can't pay everybody. So we need to restructure our debt. So instead of having a loan of, say, 8% for 10 years in your bonds, now you have a loan of 9% over 30 years. So your payments just became much less. You take that time out over, you compensate with some higher interest rates, and all of a sudden the payments get much lower, and you can afford those, and you can restructure your debt and keep going. A lot of times restructuring the debt will save the company. So you can restructure debt and so on. In fact, a lot of investment managers or investment, I don't know, put them hedge fund managers or titans of investment, whatever you want to call them, will buy companies just for the debt, because then they'll restructure the debt and save the company. They won't liquidate everything, but they'll put enough equity in so all of a sudden they don't have to make those debt payments. Then the cash flow will start going again. Once they get back on their feet, they'll repackage it and sell it again. So that could be private equity, that could be a hedge fund manager, it could be just an individual that's very financially savvy, but there's lots of money to be made in restructuring those companies like that that are cash insolvent, or that they need a capital injection and no one will give it to them because it's too risky. Somebody could come in and buy all the debt and then restructure it. Beyond that, there's another way to look at the pie. We looked at the pie earlier, which was stocks, bonds, and government. Well, bankruptcy costs are significant. Therefore, we add another column to our pie. We have stocks, bonds, government, and legal. So it's no surprise that the lawyers will get involved in bankruptcy, and of course that's a cost. So now we have the capital of a firm being made up of the stockholders and the bondholders and the government, which of course is always involved in every company, and now we have the lawyers involved. So you can look at it as the value, the terminal value of the company is the value of the stocks plus the bonds plus the government plus whatever claim the lawyers are going to make, because they're obviously going to get paid. So let's wrap this up with a few theories about capital structure, and then we can move on.